John Sprague here with Onward Property Partners, and what I wanted to share with you today is a little bit about what some of the market trends look like here on a local level in the St. Louis area. As we commonly get this question as far as what's going on in the market. And the first question is, well, tell me, why do you ask? Are you looking to purchase or are you looking to sell? And that does open up dialogue quite a bit. Now, the other thing about real estate, when it comes to a market, it's a hyper-local market, right? And so what it's kind of like putting a hot pocket in the oven and then you take it out, right? And there's certain areas that are steaming hot, they're flaming hot because you just got it out of the oven, and then there's other areas that are ice cold, right? So there's the same thing with real estate, yet what we can do is we can look at some generalities to give us a feel, a temperature check of what's going on in the market. So let's look at St. Louis as what's happened here, right? And so one of the things we do with our clients is we want to look at it as a clock. So just like any other market, real estate's no different. It's cyclical. So we've got a top or a peak of the market, and then we've got our trough in the bottom of the market. Now, if this were to be a clock, this would be our 12 o'clock, this would be our 6 o'clock, this would be 3, this would be 9, right? So what happened here in St. Louis at all, so the entire St. Louis region, what we did is we actually had our last peak in 2007 as far as home valuation. And so now what happened here is that we went through what's called a market of fear. Does anybody remember what happened in 2008? What happened? What crashed? My car? And most people, when they're talking about the economy, what do they reference? Banks, stock market, right? So what happened there in September, right, over here, was that we ended up having a stock market crash. Now, that went down quickly, right? Now, what's interesting is that it took us 4 years to get to the bottom here in St. Louis, right? And that's even with some government interaction with quantitative easing. If you guys remember, there was government tax credits for first-time home buyers, so anything that they could do to stimulate. So they actually slowed down this economy based on fear, right? So that moved pretty rapidly. Now from 7 to 11, here locally what we did is we lost 19% of our value. On average, homes lost 19% of their value. And then what ended up happening is that it took us 44% longer to sell a home. Now, where this really comes into play is that if we've got a unique home, we were just talking about that, unique's not necessarily a compliment in the real estate world, because what we've done is we've effectively reduced our buyer pool, right? So whether it's a unique home, or let's just say a home that's on a well-traveled street, what's going to happen down here when our buyer standards are really high because there's a lot of inventory, what's going to happen is that this person that's got that unique property, they're going to have to be even more depressed with their price, right? So they're even further down than the person tucked away in the cul-de-sac or what have you. So from 2011 to where we're at 2018, what we've seen here is we've seen a 31% increase from 2011. So what does that give us a net from 2007 to 18? Where are we at? How much did we grow as far as home valuation? 31 minus 19. 12. Great job.
There it is.
12. So we're up 12% on average here from 2007 to 2018 in the residential real estate market, right? And so again, your market as far as your neighborhood might be a little bit different than my neighborhood and your neighborhood too, right? So, but this gives us a good temperature check as far as what's going on. The other thing too is that we've got actually 15-year lows with inventory, right? So that tells us right now that there's not a lot of supply out there. So buyers' standards are relaxed. They say, if I want to get into this school district, at this point I just want a roof, a kitchen, and a garage, right? Down here they want a roof, kitchen that is granite, stainless, and everything is remodeled perfectly, right? And down here you gotta be number one. It's a price war and a beauty contest, and we gotta be winning both of them, right? Up here, we just have to make sure that we're priced appropriately and we're in a condition that matches our price. Does that make sense? Not much change with that too, but we're just getting more aggressive here. Now what's happening here is that we're seeing a lot of things that are very similar to 2007. So what happened in 2007 one of the first things that we saw is that our active investors that were looking to buy, fix, and flip, the experienced ones, they started to slow down a little bit. What would cause them to slow down in 2007? By the way, think about this. HGTV, they're getting its big, their first big push. There's a lot of new investors coming to the market. Those new investors are a little bit more naive. They might not know about silent cost. They might not understand the market as much. So what they're doing is that they're buying properties that the experienced investor would be buying at a lower price point. They're bidding them out, right? They're overbidding for them, and they're beating those investors out. Those investors are not comfortable with the amount of risk with the smaller level of reward. And guys, what's interesting about this is we're seeing the exact same thing happen here in our market right now. And what that's telling me, these guys, they're the canaries in the mine shaft, right? They're the ones, they're putting their hard-earned money on the table, and it's a pure speculation play. And right now they're saying, I'm not gonna do it, right? So us as homeowners should probably take note of that, right? And so what's happening is that if they're thinking we're up here, now all of a sudden we're seeing some of the days on market start to rise a little bit. That's starting to go ahead and allow inventory to swell. And then you've got the Fed that just came out yesterday and said we're going to continue our short-term interest rate hikes over the course of the next short while, as intended, right? And the other thing too, little sidebar here, it's not necessarily the Fed or the news that's going on in the Fed that we need to be overly sensitive to. It's actually the 10-year Treasury note. Mortgage rates are attached to that 10-year Treasury note. So if that Treasury note's trending up, then what's going to happen is it's going to put a negative impact on home affordability. To give you guys an example, for every 1% that the interest rate goes up, a buyer's affordability or a buyer's buying power goes down 11%. Now that doesn't contribute to an in-kind reduction as far as valuation. The research shows that when the market goes up 1% as far as interest rate, that puts pressure 7%. There's usually a 7% decline as far as home valuations, right? So right now we've got inventory that's swelling. We've got buyers that are seeing potential affordability challenges. We're having a major challenge with buyer fatigue that's caused by buyers getting beat out in competition, or not even engaging the market because they say, gee, Mr. Seller, I see that you're asking $400,000 for that home, and you know what, that's kind of crazy. But the crazier thing is, somebody's going to give you that 400 grand. It's just not going to be me, right? And so they're not even engaging the market. So that's something that's a true concern for us here in 2018. Oh, by the way, typical real estate market to do a full cycle is somewhere between 8 and 10 years. So some could say that we're on borrowed time, right? So when you sit down with economists and say, hey, where are we at in this market? I'll tell you that you're going to have 10 different answers, right? And a lot of it is going to be appropriate for each different hyperlocal market. And that's why it's important to sit down with a professional to make sure that your pricing is in alignment with where the market's at. Because what you certainly don't want to do is be here chasing the market because you came out on the market here with too much optimism, and now we're overpriced chasing a market that is retreating, right? That's one of the worst things we can do as a seller. So this is a little bit about what's happening in the St. Louis market, and as you have questions about it, don't hesitate to reach out. Love to go ahead and be a resource for you and make sure we know exactly where your home falls in on the old clock valuation. Thanks so much, and I'll see you next week.